The FIRE movement, financial independence, retire early, has turned personal finance into a high-stakes obsession. Millions of investors are now searching for a flawless portfolio that can permanently replace their salary. This pursuit often involves tracking net worth daily, hyper-diversifying across a dozen asset classes, and rushing to eliminate every penny of debt to reach a state of perceived perfection. The flaw appears when the market stays flat for 2 years. When spreadsheet projections don't match a stagnant portfolio, the pressure starts to mount. This is time risk. It represents the psychological gap where an investor's mental fortitude fails to handle the long, quiet periods where their money is underwater and the strategy seems to be failing. Professor Patu represents a different path. He built a retirement corpus designed to last for 50 years by ignoring many of the common rules of modern financial optimization. He reviews his portfolio just once a year. When he invests, he does so with the expectation that the market will drop immediately afterward, removing the stress of trying to time the bottom. Sustainable financial freedom may require moving away from the high-stress optimization of the modern playbook in favor of a simpler, more durable mindset. Most advice suggests setting up an automated monthly investment and letting the system run on autopilot. This is often viewed as the ultimate path to wealth. However, a set-and-forget mentality can lead to complacency. When the process is invisible, investors stop optimizing their spending, leaving potential capital on the table as their income grows over time. Manual investing takes less than a minute on a smartphone, yet it forces a conscious psychological check-in every single month. This monthly interaction encourages active lifestyle compression. If you invested $10,000 last month, the manual process nudges you to find a way to invest $10,500 this month. Wealth generation relies on the raw discipline of continuously increasing the principal amount invested, which carries more weight than chasing a marginally higher return percentage. Discipline often falters during large market booms, when FOMO drives people to chase assets like gold or international stocks simply because they are currently at a peak. Higher risk does not ensure higher return. Increasing risk simply expands the spread between best and worst possible outcomes. Diversification serves a mathematical purpose. It tightens the range of potential outcomes. It's designed to contain volatility, not to maximize yield. Buying an asset because it is currently making headlines is the opposite of diversification. It is a move that often leads directly into the next cycle of volatility. Perhaps the most persistent financial myth is the idea that you must aggressively prepay your home loan to achieve security. Prepayment ignores the time value of money. While mortgage payments stay fixed, their actual cost relative to your rising salary shrinks significantly. A better strategy is capping the payment at 30% of your pay, directing surplus cash into a liquid fund instead. This side fund creates a dual benefit. If you lose your income, the fund covers the loan payments. If you stay employed, the investment returns historically exceed the interest rate of the mortgage, leaving you with more wealth at the end of the term. A controlled mortgage acts as a strategic tool to build liquid assets and psychological security. The retirement math is clear. Multiply your essential annual expenses by 33 for a safe 3.5% withdrawal rate. At retirement, to preserve capital, your portfolio of 60% equity and 40% debt flips to 60% fixed income. While the formulas are simple to calculate, executing them requires a level of personal sacrifice that many find uncomfortable. The primary obstacle is lifestyle creep, the tendency to increase spending every time your income rises. This cycle prevents even high earners from ever accumulating enough to stop working. Surviving market cycles requires moving past the noise of financial news and market timing. It demands a strict commitment to long-term asset allocation and a refusal to react to daily market fluctuations. Financial independence depends on the relentless discipline of lifestyle control and the quiet, steady progress of consistent investing.